Welcome to the Ellsworth Advisors monthly update for May 2024. I'm Kelly Keenan. This is Cameron Mealy. Today we're going to discuss how our portfolios performed over the last month, year to date. Also, kind of give you an update on economic numbers and what our thoughts are moving forward for the next 30 to 60 days. Cameron, why don't you kick us off with some economic research?
Will do. Thank you, Kelly. Good morning, everybody. Hope everybody's well out there. A lot of numbers over the last month that we can dive into. Let's start with GDP. On May 30th, the Bureau of Economic Analysis reported that according to its second estimate, first quarter GDP increased at an annualized rate of 1.3%. The current reading of 1.3% is down from the advanced estimate. It was initially reported at 1.6%. When the information is reported, they start with the advanced rate, second estimate, then the third estimate is usually their final reading. So we're now seeing GDP at 1.3%, which is significantly under kind of the 2% target that most economists look for. And this number is significantly down from 3.4% as of the fourth quarter. The primary issue, and this is interesting, the primary issue that was cited for the slowdown in GDP is a slowdown in consumer spending. You know, during this whole COVID wave, post-COVID, the consumer has really been driving the economy through their spending, and we're starting to see that slow down. It is starting to trickle through all numbers. So right now, 1.3% GDP for the first quarter. If we advance to the second quarter, on June 3rd, the Atlanta Fed and their GDP Now forecast model, they're estimating second quarter GDP to come in at 1.8% annualized growth rate. So again, starting to see that slowdown. It's trickling through everything. Let's talk about April jobs. On May 3rd, Bureau of Labor Statistics released its April jobs report. The U.S. added 175,000 non-farm payroll jobs. This is down from the Dow Jones consensus estimate of 240,000 jobs. The unemployment rate did tick up from 3.8% to 3.9%. We have the May jobs report coming out June 7th. It'll be interesting to see where that comes in. Current consensus is about 200,000 jobs, and if current form follows through, we're probably going to see less jobs. Couple of the inflation numbers. We always, right now, inflation is really one of the hot button issues. Everybody's kind of waiting for the Fed to start some interest rate cuts. It doesn't look like the Fed's in any hurry to do that. They're very mindful of where we're at tracking with inflation. The Fed's really key goal that they look at, key gauge they look at, is the Personal Consumption Expenditure Index. On May 31st, Bureau of Economic Analysis reported that Personal Consumption Expenditure Index increased 0.3% in April and 2.7% for the preceding 12 months. As we constantly talk about, the Fed's real goal for inflation is about 2% on an annualized basis. So according to the Personal Consumption Expenditure Index, we're still running at 2.7% year over year. Producer Price Index. So these are the costs that producing public businesses are seeing. On May 15th, Bureau of Labor Statistics reported the Producer Price Index rose 0.5% in April. Over the past 12 months, the index has increased 2.2%. The 2.2% increase was the largest increase year over year since April of 2023. One more number, the Consumer Price Index. So this is the measurement of what we're paying as consumers. Consumer Price Index on May 15th, the Bureau of Labor Statistics reported that the Consumer Price Index increased 0.3% in April after rising 0.4% in March. Over the last 12 months, the index increased 3.4%. So the major inflation gauges year over year, we're seeing 2.7%, 2.3%, and 3.4%. That has obviously come down significantly from where we've been, where we were tracking post-COVID, but that's still not in the range right now where the Fed wants to be. This Fed is continued, every Fed president, Fed Chairman Jerome Powell, they have harped on this message of we've got to see inflation under control. Don't expect, just because everybody wants it, interest rates coming anytime soon. And there's still a feeling on Wall Street, still a feeling with economists that we could be looking at 2 potential interest rate decreases in the second half of the year. I'm not sure about that.
Well, it's a lot of the consensus has been pushed out towards the end of the year,
Yep.
Maybe after the election. Pretty much unlikelihood anything's going to happen in the next month or so. I'd say, the Fed wants to see a real trend. They're not going to jump the gun just because of a month or two's data. They want to see several months, and the reality is that several months takes us into the fall. The election, there's a lot of controversy. Would they actually do anything right before the election? Probably unlikely, because that could add some political connotations to it. So that kind of leads us to maybe November, December is if they start cutting, that's when it would be. But we're still seeing economic growth definitely slower, which is part of the Fed's objective. You have to slow things down to cool inflation. Looks like inflation is starting to come down, not to the levels they want it to be, but the trend is, we're starting to see a trend, which is good. And
the consumer spending number,
that
is what is the biggest concern.
Correct.
Because as I said, the consumer has been driving the economy over and over again. And if people are now starting to feel, we're seeing, again, credit card debt is really going through the roof. We're seeing personal savings rates at kind of all-time lows. It seems like the consumer is tapped. And obviously, as the consumer goes, we're going to see the U.S. economy go.
COVID money is probably about gone. Obviously, higher prices. Wages have come up, but haven't quite kept up to price increases. So that's all part of bringing the inflation down. And the big key is the question mark is, do we go into a full-blown recession, or is it kind of a softer recession, or what they call a soft landing, where we really don't slow to a negative point, but just, really the economy, slows, doesn't get real bad, and then we get back into a new growth cycle. That's the wild card. And, from a market standpoint, this type of environment, we had our correction back in March. April was a nice recovery month. May for the markets actually turned out to be halfway decent. The S&P was up 4.21%. But the Dow Jones was only up 1.21%. And then you had the NASDAQ up 5.64. The reality is, what drove the NASDAQ and the S&P 500 was, a big part of that was NVIDIA stock. So now you have a few stocks kind of driving the train. The Dow Jones, I think, is maybe a better reflection of the market as a whole, which, once again, advanced, but not at a rip-roaring pace. It didn't crash either, even though we're seeing some weakening numbers. And, I think we very well could see this trend continuing where, we either have, mediocre performance, unless you get, a big stock in there kind of driving performance. But the reality is, relying on one or two stocks to drive the market is not necessarily a positive thing. So, but with that said, we are trending upwards. We were off to a nice start for the year. The S&P is up 10.64%, but then here's the divergence. The Dow is up 2.64. About halfway through the year, NASDAQ up 11.48. Small cap stocks for the year in May were up 2.68, but year to date, once again, only up 2.12. Once again, a broader look at the economy. On the international front, the EAFE was up 3.16 for May, year to date up 5.34. So we are seeing some recovery in the rest of the world. Some of the other central banks are already talking about cutting rates, so they feel like they're at a point where they've brought inflation down and they want to not stall their economies. In the emerging market world, for the month, negative 3.7. Year to date, emerging markets up 2.46. So that's really what's happening with the markets in general. Our portfolios, our growth of income portfolio in May was up 2%, year to date up 9.4. So we're off to a pretty good start, almost halfway through the year. Once again, stock I just mentioned, our big winner in May was NVIDIA, up 27%, year to date up 121%. So obviously that stock is definitely driving the S&P and the NASDAQ. It is not in the Dow Jones. Another winner in May, Aptiv. We purchased that early in the month. That's up 17%. Apple up 13.5%, and then Raytheon was up 7% for the month. Laggards in May, Disney, showing some signs of life, struggled again last month, down 6.5. EOG Resources, which is a natural gas producer, down 5.7. Toyota Motor down 4%. Another gainer for the year, Raytheon up 30%. Exxon still up 19%. Berkshire Hathaway up 16.2. Laggards for the year, Nike down 12%. Once again, they kind of showed some life last month, but are still struggling year to date. And then our real estate ETF is down 4.2. Our dividend yield portfolio, decent month, up 1.6%, kind of in line with the Dow. Year to date, still up 7%. So, a nice start to the year for our dividend portfolio. Prudential is up 10% for the month. Southern Coil up 10% for the month. Packaging Corp up 6%. Laggers last month, Kraft Heinz took a little hit, down 8.4. McDonald's down 5.2, UPS down 4.8. Year to date, our big winners in this portfolio, Eaton's up 39%, Waste Management up 18%, Prudential up 18.8, so the insurers are doing pretty well. Caterpillar up 15. Laggards, Public Storage down 9.3. UPS struggled UPS actually had a good month, but they're still down 9.7 for the year. Cisco Systems down 6.5. In our appreciation with income portfolio, kind of a newer portfolio, year to date up for the month of May up 6.2, year to date up 16%. Really, this portfolio's kind of brought it on. It didn't do a whole lot last year or the previous year. In May, late in the month, we actually bought Hewlett Packard, which we picked up 30% on that just in the last 10, 15 days of the month. General Digital up 24%, Equitable up 12.2, once again insurer up, and Bank of America up 8%. So the financials are starting to come on. Laggards, as mentioned before, Toyota down 4%, Merck down 2.9, BP down 2. So not a lot of big down stocks. Year to date, a big gainer that we just sold about 2 weeks ago, Vistra, up 158% for the year. Equitable up 25.5%. JP Morgan up 20.6. So, and Energy Transfer up 18.4. So some nice year-to-date gainers in there driving that portfolio. Year-to-date Public Storage down 9.3. Kenvue down 8.5, and Union Pacific down 4.2. Price potential portfolio. This is definitely this portfolio historically is usually the best performer in decent markets. Price potential for the month was only up 0.9%. Year to date, up 2.8%. Just kind of trying to get traction in there. It'll eventually come, but we have to be patient. For the month, Markel was up 12.6, Arch Capital up 9.7, Graphic Packaging up 9.6. Interactive Brokers 9.4, so nice gainers. But on the downside, General Parts, they hurt us down 8.3, Intuit down 9.7, Janssen Pharmaceuticals down 5. Year-to-date, Interactive Brokers still the leader that we're holding on to, up 52%, Arch Capital up 38.2, Allstate up 21, another insurer that's helping us. Laggers that's still in the portfolio, Integral Life Sciences down 29, Intuit down 7.4. Small cap portfolio, good month in May, nice rebound month, up 7.4, year-to-date up 11. So this portfolio definitely outperforming its index. Big gainers in May, Kyndryl Holdings up 35.6, that's just for the month. Camtech up 26%, Squarespace up 26%, Miller Industries up 25. So some big gainers in May. On the downside, Osprey Manufacturing down 17, Global Industrial down 9.5, and Federal Agricultural Mortgage Corp down 6.2. Year to date, still in the portfolio, IES Holdings up 94%, United States Lime and Minerals up 49%, Graham Corp up 43, Miller Industries up 44. For the year, the Federal Ag, like I said, they had a nice month last month. But year to date, they're still down 8%, so we're digging out of a hole there. Corvell down 3.3%. And then that pretty much wraps up for the portfolio. So a decent month, not as strong as last month. Expectation-wise, we're kind of in this, I think it's going to be the doldrums of the summer. I don't see a lot of big macroeconomic surprises coming down the pipe.
No.
It's going to be more, I think, kind of GDP numbers, inflation numbers. I don't see them being much different than what we've been seeing for the last couple months. Hopefully a little bit of improvement that takes a little pressure off the Fed, but I don't see any big spikes up or any big fall off, so that will probably make for a fairly boring summer, which means we're going to have some volatility, where it's going to be a little bit of give and take. The market's definitely becoming more selective, where the tide's not necessarily lifting all boats, and the key is going to come down to, how are the individual companies performing? How do their cash flows look? how their balance sheets, that's really, I think, can be the key for the next several months. But in general, I think, the momentum is to the upside, and, I think we're going to get out of the summer fairly unscathed, but probably some bumps along the way.
Bumps along the way, there's going to be volatility. We've already talked about we're walking into probably one of the more difficult presidential elections that this country has seen. And there's going to be a lot of headline risks. There's going to be a lot of news stories, negative stories. There's going to be an overexcitement to report on those. So we're going to see volatility. We're going to see we're going to see divisiveness within this country. Most important thing is if you need cash, we probably already have you in fixed income. If you know you're going to need cash, let us know so we can get you into fixed income. Stocks are going to be volatile, but this is a long-term situation. It's a long-term gain. You got to stay invested.
You mentioned fixed income, which I really didn't touch on, but the reality is I don't see much changing in the interest rate picture, at least for the next 30 or 60 days, which the reality is from a saver standpoint, from an investor standpoint, we can park money for short term and get over 5%. So that's something that's we haven't been able to experience for years.
We call that novel.
Yeah, so that's nice, and that doesn't so I kind of like where we're at right now. At least in the short term, we can handle where interest rates are at this point.
Yeah. Obviously, if you have any questions, if there have been any changes to your financial picture, please let us know. We're always here, and we'll talk to you in another 30 days. Hope you have a great month. Thank you very much.
Thank you.